Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with John Rubino. You can follow John on Substack, where we will post a link in the show notes. John, we're going to start off by talking a little bit about Q2 earnings coming up for the precious metals stocks, and we can even dive into and isolate the difference between maybe the royalty companies and the actual miners. The miners being a lot more dependent on mining costs, while the royalty companies, they just need more ounces coming in because they already have a nice margin. Overall, though, we're seeing GDX so far this quarter up about 11-ish%. Gold is up right around 5 to 6% this quarter. The question being, when we get Q2 earnings, which will be better than Q1 because of these higher prices, will the market take notice? What will you be paying attention to, John?
Hey, Corey. Hey, Chad. Well, yeah, this is going to be an interesting second quarter earnings season. And I don't think that most of the market is paying attention to the miners. And they've got NVIDIA to think about. So, looking at Newmont or something, no matter how it works out, has got to seem kind of boring to the average investor right now. And that creates the possibility of some really pleasant surprises, right? If nobody's paying attention. So gold is up around $300 an ounce year over year, second quarter to second quarter. And that means that revenues ought to be very positive for basically anybody in the gold space. And silver's up a little more in percentage terms, so it should work for silver miners and related royalty companies too. But the mathematical difference is going to be pretty dramatic because let's take the royalty companies to begin with. Now, they already have excellent margins because basically what they do is they finance some new mine that's coming online, and they get some gold or silver in return for that financing. And so the difference between the gold ounces coming in, the price of them, and the gold ounces that they're selling is usually pretty dramatic. And there was just a report from Sandstorm Gold that they just put out about their second quarter production. And they mentioned that they made about $1,700 per ounce of gold in 2023's Q2, and they're going to make about $2,000 an ounce this time around. So those are phenomenal margins. It's not a gigantic increase year over year, but it's still just excellent from an operating model standpoint. So, you would expect Sandstorm to put up some pretty good numbers in terms of cash flow this time around, but it won't be crazy, 200% increase like you might have with a miner that gets it right in a bull market, but it'll still be excellent. So you definitely want to own the royalty companies in a precious metals bull market. But I think the real big surprises, to the extent that they come at all, will come from the miners, where their costs have been going up, and that's been offsetting the increasing price of gold. So their cash flow is actually maybe down in the previous few quarters. But this time around, year over year, the increase in the price of gold was enough to outpace the increase in their costs and give them a big margin expansion and rising earnings and stuff like that. And so with the best run gold and silver miners, you could see some very pleasant surprises in free cash flow and net earnings, and that might allow them to raise dividends and buy back stock, do all the things that companies do when they're making serious money. So this could be a better quarter than people expect, in part because it might be a pretty good quarter for some miners, and in part because nobody's paying attention, so they have no expectations whatsoever. So I'm looking forward to seeing some of these numbers, see what Newmont comes out with, and seeing what some of the mid-tier producers come out with. And there could be, in that bunch of reports, some very good numbers.
Well, John, just to that point, and it's a great point that, the royalty companies already have fat margins. Their margins will get fatter because it's $300 more in gold. Some of the best run miners will have margin increases instead of margin contraction. So that's a better narrative than the margin contraction narrative that we've had the last couple of years. But what about the worst run miners, the companies that were basically treading water, not just gold here, let's talk about gold and silver. A lot of these companies that were the smaller producers or the mid tiers, sometimes when we see a jump in silver prices like we've seen, or a jump in gold prices like we've seen year over year, quarter over quarter, the worst companies have the biggest margin percentage increase. Their percentage increase is so much more dramatic than, let's say, a Newmont or a Sandstorm. So what would you say about some of the mid tiers and the smaller companies finally getting on investors' radars because they're finally making money?
Well, yeah, a bull market bails out the weakest players in an industry, right? That's how rising prices for whatever you're selling works. And so, yeah, you can get some phenomenal percentage increases, but it's got to be a percentage increase that takes you into profitability, I think, before a miner deserves any real attention here. Because if you can't make money in this kind of an environment, it's completely conceivable that we have that recession and the equities bear market that pulls down precious metals sometime in the coming year. And if you're not making money now, and gold goes back down to $1,500 an ounce or whatever for a while before the V bottom sends it much higher. But anyhow, if it does that for a while, then your numbers are going to be just brutal. So you still got to be careful with those kinds of big percentage increases, unless you're sure that the top line growth is going to continue. So it becomes a separating the wheat from the chaff story at that point. Some of these little companies might report much better earnings and revenues and margins, and they might get a price pop out of it, but it's got to be sustainable. So that's where security analysis comes in. And that's where, a service like yours, where you talk to the CEOs and get a real sense of what's happening with the companies, come in. Because you can't just buy an industry when the industry is something like mining, where a lot of these guys are existentially threatened by the current situation. And if you just throw money at them, you're throwing good money after bad. So it's very important to understand the company when you've got an earnings season like this one, where a lot of good numbers might be coming out, will be.
Yeah, that's a very good point, John. Maybe don't get sucked in by some of the major changes. Stick to, I guess, the higher margin producers. What's your assessment of the majors, though? It is where big money would go first. Do you see the majors as being healthy? Do you see the majors as still a bifurcated market? What's your view on the major gold miners?
Well, they've really got to be controlling their costs at this point, because costs have been going up dramatically. And if they can't profit from gold going up by $300 an ounce year over year, if their costs are still going up at a rate that offsets that, then you just got to wonder about the business model. They've got some mines that are really just not that high quality, or the labor situation is just unmanageable. I don't know. Or, energy costs are not up that much year over year. So energy should be a rising expense, but not a debilitatingly increasing one. Labor is brutal in the mining industry, no doubt about it, but you still have to find a way to manage that if you want to be a good investment. So I think the big miners are going to let us know with these quarterly reports who's well managed and who's not, and I pulled up Newmont's just to get a sense of how this is working. And I looked at their Q2 2023 report versus 2022. And back then, gold had gone up somewhat. So revenues were rising per ounce, but their costs went up even more. And their all-in sustaining costs went from like $1,100 an ounce to $1,400 an ounce. And that was enough to more than offset the rising price of gold back then and gave them contracting cash flow. So you can't see that again if you want investors to be putting money into your stock. So we'll have to see. I think it's going to vary, obviously. And I'm interested in how it varies, because that's going to tell us an awful lot about the long-term viability of these companies. If they can't make money now, then we've got to see gold go up to $3,000 an ounce before these guys really start seeing any net profit benefit. If it's not going to work its way down to the bottom line now, then we need to wait until a lot more of a price increase comes. So we'll see. I am cautiously optimistic. I think the numbers are going to be by and large pretty good, and they're going to be by and large a surprise to people who aren't paying attention. But as far as the specifics go, it's going to be fascinating to watch, because I think the royalty companies are obviously going to come out of this looking very good, not spectacularly, not 100% growth or anything like that, but just like really solid companies that can make more money in a bull market in the thing that they're selling. And I think some of the miners are going to look like that too afterwards, but we're going to have to wait and see which ones.
Well, John, this discussion leads me to think about some of these producers that are going to have a lot fatter margins now because the price of the metals have outpaced their costs. are also going to have an increased balance sheet, but they still have to replace their reserves. So do you think it'll spur more M&A? And I don't actually mean the majors, because the majors have been cannibalizing each other, and now there's only about 10 majors left doing over 1 million ounces of production a year. But there are 4 to 5 dozen mid-tiers that are doing between 100,000 and 1 million ounces per year that are going to be making money, but still need to replace those reserves. Do you think when their share prices maybe get the inflows of capital first, that gives them the leverage to go out and acquire some of the junior companies?
Oh, absolutely. Rising cash flow has to go somewhere, right? So this, what I would call the smarter miners, will buy back their own stock and they'll pay dividends and things like that. And a lot of the other guys will decide to build empires because it's just, I mean, that's hard to resist. I get it. You know, when there's a bunch of cash in your pocket, you want to spend it, and you want to spend it in ways that increases your profile in your industry. So there will totally be a lot of M&A. If it just becomes clear that gold is going to stay at $2,400 an ounce and that silver is going to stay in the 30s, okay, that's all it will take to ignite a lot of M&A in this market. Because, you know, if especially the big miners that have an all-in sustaining cost that's not very impressive, they're going to be looking around for low-cost deposits that can bring their costs down when they bring them online, because they want to move the needle. And there are some deposits out there that'll do that. So the question is, when does this change in industry attitude happen? You know, when does newfound gold suddenly have 5 or 6 majors calling them up and saying, hey, can we take a tour? You know, something like that. And then a bidding war. So I don't know. And when does something like Silvercrest Metals, which is doing very well, you know, they should have a good Q2. And when do they become a nice new thing to add to the portfolio of a big company? And we'll see. You know, I think all of that stuff, given the history of mining, I think all of that stuff is out there once cash flows start being pretty good and the price of gold and silver feel predictable. In other words, we think they're going to stay where they are, or if they move at all, they'll go up from here. You know, that's the kind of thing that I think will ignite a lot of activity. And I don't think we're that far from that. You know, we have to get through the coming recession and figure out what that does to precious metals. And then we move on to the Fed panicking and liquefying the economy like crazy this time, which they're going to do because they're terrified of interest costs going through the roof for everybody, and you know, government debt going parabolic in a recession. They don't want any of that to happen. So they're going to go back to QE and turbocharge it next time around. Then gold and silver will take off. So we just need to know what the valley is going to be when the economy slows down, equities get whacked, and what does that do to precious metals? And once that is pretty well understood, and let's say it's $2,000 an ounce for gold, that's all the further it falls, and then the Fed comes in and starts liquefying, then we're off to the races. And then the M&A thing really goes crazy. So we'll just have to see how this plays out. But you can picture a scenario in which all of a sudden, you know, the miners have enough money, the big miners have enough money to buy the mid-tier producers. And then when they're done with them, go after the explorers that have big deposits. And it turns into a 2 or 3 year orgy of M&A for the miners. But got to look at that valley first and see what it looks like.
John, how are you timing out this valley then? You mentioned possible recession a number of times in this interview. We've talked a lot about the weakening data out of the U.S. It's not in contraction yet, though. When do you think this potential recession could come? What are you looking for as signs that it's here?
Well, I thought it would have come already, so I'm not really a good source of timing advice. But you know, the headline numbers are pretty good still for the U.S. The unemployment number and the inflation number that they report before they go in and revise everything back to what it really is. You know, those headline numbers are okay. But under the surface, there's a lot of things happening that point towards a slowdown. You know, you can find 20 charts right now where, you know, the line goes back and back for the last 20 or 30 years. And every time the line does this, a recession follows. And every time the line does this, a recovery follows. There are so many indicators out there that all point to the same thing, that we are in the beginning stage of a slowdown, which will lead to a recession. So a few that I like are excess savings, which is the money you have in the bank over and above what previous trends would have indicated. And during the pandemic lockdowns, Americans at least accumulated a couple $1 trillion of extra money. We've been spending that ever since, and now it's gone. Now we're into negative territory, where we've not only spent all of our previous savings, but we're having to go into debt in order to put food on the table and gas in the car. And the interest costs that are related to that are rising dramatically. They call that personal interest expense, and that's gone parabolic. So you get a situation where credit card debt is way up, savings are way down, and the interest on personal debts are spiking. And that means consumer spending is probably going to slow down, right? So consumer spending is 70% of the US economy. Let that slow down and the economy slows down. And nothing mystical magical about this. It's happened 20 times since World War II, and it always kind of plays out the same way. And since interest rates are high and the Fed is not cutting interest rates, there's no aggressive monetary policy response trying to head this off. So I think that it's completely reasonable that we have a slowdown which leads to an actual contraction sometime in the second half of this year. And that gives us all the usual stuff. Then we get the equities bear market, et cetera, et cetera. And it won't be anything that radical. It's just that when all of these indicators point towards a recession, every single time in the past, it's always happened. And if it happens again, it'll just be history replaying as it always does.
Well, John, there's a number of people in the precious metals sector, and maybe it's their own bias, but they believe that if the markets roll over and if there is a recession, it'll actually be a boon for the precious metals, and they actually will diverge from the stock market and not get sucked down like they did in the 2008 great financial crisis or in the pandemic crash of 2020, because this will be more of a structural situation where people may flee out of the markets into gold as a safe haven and even into the gold stocks. Is it possible that the gold and gold equities actually bifurcate from the markets in that kind of event, and that actually fuels the move into precious metals?
Yes, it absolutely is. And what that takes is for us in the market to change the way we understand and respond to market disruptions. In other words, it used to be when things got really disorderly, people would sell stocks and buy bonds, right? Well, if the disorder that we see coming is going to be currency related, in other words, if we expect the Fed easing aggressively to ignite inflation, cause bonds to crash, when we don't want to hide out in bonds anymore, right then, and cause the big fiat currencies to start falling in value dramatically, then of course you want to be in precious metals then. So it has to be a change in expectations, though, for that to take place. Just to, inflation is kind of determined by inflationary expectations. And I guess it would be the same thing with precious metals. The attractiveness of gold and silver depend on our expectations of what the next disruption looks like. And it could easily look like that. It could be when everybody sees things falling apart out there, which is kind of typical at the beginning of a recession. It looks like some industry over here is failing and a lot of people are going bankrupt and stuff like that. Well, if we see that and think, oh my God, the Fed is going to just flood the system with cash now, they're going to panic like crazy, then yeah, maybe you just skip the whole precious metals tanking and then buy it at the bottom. Maybe it's a buy at its current price. And, with history having done it differently the last two times, 2008 and 2020, both times there was an equities bear market that pulled gold and silver down. I wouldn't bet the farm on it being different this time, but it totally could be. And if that's the case, then that means we're at the end of the fiat currency, fractional reserve banking, global military empire experiment that started in 1971. And then everything's going to be different. So I'm kind of positioned for that, even though I've learned not to just assume that that's absolutely going to happen. But if it happened, then, your basic gold bug portfolio, the stackers would really make out in that kind of a situation. So let's get it over with, would be my take on that. I can't say for sure that it's going to happen, but it certainly could happen.
Yeah, we'll see what will happen here. Look, a lot of the gold stackers, I'm sure, would love for these gold stocks to truly go vertical. Some have, but not the whole sector has. But the metals prices have sure done well. We'll see how the recession, if it comes, when it comes, what impact that has as well. John, thank you as always for your time. As I mentioned, we'll post a link to John's Substack in the show notes. We'll chat with you in about a month's time. John, thanks for your time today.
Great. Thanks, guys.